Thank you for being with us this evening. My name is Eddie, and I'm excited for us to discuss the Student Aid Index topic. Now, if you've been to a Juno webinar before, you may have heard about this SAI number. What is it? If you've applied already to college, maybe whether the admissions process and the financial aid process, many of you in the audience might actually be waiting to hear financial aid offers or have already received financial aid offers. If you're joining, I'd love to hear who is in the audience. If you could just post whether you are a student, a parent, if you're a student, what year you are, parent, if you're willing to share the year of your child, just so we get a sense of it, who's in the audience. And then let's jump in. So I'll open the chat up here, so you should be able to comment. I will disable the chat a little bit later though, because if you have any questions, please make sure to use the Q&A feature. It's going to be a little bit easier for me to manage the Q&A than to have to look at two different places. And then I'll also mention, feel free to take notes. You can rest assured knowing that the presentation, the recording, and the slide deck will be shared with you after. And so again, if you have any questions, feel free to post them in the Q&A. Don't feel the pressure to jot everything down. We're going to get into some a little bit more technical information today, but I want to go slow and break it down so that everyone here is understanding how this SAI number is calculated. And so, oh, awesome. I see a couple of parents of high school seniors, school counselor, a rising med student. Great to have you as well. We will not focus on the medical process, just so that you're aware, Loda. But we do have a lot of webinars. My colleague Jason hosts a lot of webinars as well, specifically for med students. You are welcome to join here as well. You're welcome to access all of our other webinars that's available on our websites, joinjuno.com/webinars. But again, feel free to reach out to me directly. I'd be happy to put you in touch with any med school related questions. But again, as we think about the Student Aid Index, just a little bit about, first, I'll introduce myself. I work at Juno here on the undergrad side. I spent my career in education. I was previously a college counselor at a private boarding school, and I was also an admissions officer both at Yale University, at Williams College. And so I've seen this day in and day out when I was working directly with families, both on the admission side, but of course that's closely related to financial aid and the decisions that families have to make in order to actually attend their university. Now, from the outset, I want to mention that we're not giving investment advice here. We do talk about financial services, but again, I want to make sure every family does their own due diligence. I'll share information that is worth you considering. It's meant for educational purposes. All right, so we'll go through the timeline here, and then really to understand what is the Student Aid Index. You may have heard of this term a lot getting thrown around. It's a relatively new term. It used to be called, there was a term previously called the estimated family contribution. So if you've had previous children apply in past years, or if you have siblings who had previously attended college, you may have heard of a different name. That's a different the different idea that no longer exists, the estimated family contribution. So we'll talk about how this gets calculated. That's really where we're going to get into um, the the deep part of this presentation. And then, of course, the most important piece is how to actually reduce your student aid index, right? Because that's going to be what determines how your SAI impacts financial aid. The actual amount that you will then receive is based on the student aid index. We'll save time for Q&A. Again, feel free to post your questions in the Q&A. That'd be most helpful for me. And then I'm going to disable the chat for now. So again, I'll just direct you to the Q&A. Now, as we go over the different timelines of the year, right now we are in March. So many of you have already submitted FAFSA, gotten your student aid index number, especially for all the seniors and parents of seniors in the audience. You already applied to college, and you're now starting to, or will soon start to receive your financial aid offers. This is the heart of where we are in the timeline of the process. We host a webinar as well on appealing financial aid, which will actually be next week, later this week, excuse me, this Thursday. But please know that you actually are able to appeal your financial offer. And we encourage, there's very specific reasons to do so. I won't get into those during this presentation, but that is an important part of the timeline, which will ultimately determine which school a student may be able to enroll into. It has to be financially viable. From that point, after you've exhausted any kind of grant funding sources from the institutional, from external scholarships, then it might be worth considering how to fill the gap. Namely, that oftentimes happens through student loans, additional student loans, before your tuition due date is due. So a really important intro that I'll mention here, I won't go too much in depth, but I wanted to start talking about this because this change is happening in just a few months. So starting July 1, the federal government has passed the bill last year as part of the One Big Beautiful Bill Act. It includes student loan reform changes. So for any high school seniors and parents of high school seniors, I saw several in the chat, this is directly relevant to you. I'll mention just a quick comment first about any current college students who may be tuning into the call or any parents of current college students. If you are currently enrolled in university and you have taken out a federal direct loan in the past, then you will qualify for what's called the legacy exception. Now, this is what's colloquially called as being grandfathered in to the old terms of the loan. So if you notice under current policy, what the Parent Plus program allows a parent to borrow up to the cost of attendance. And I'll clarify even further here. These changes are specifically targeting Parent Plus borrowing capacity. So previously, at this point currently, up until July 1, until June 30th, technically, a family can borrow up to the cost of attendance with no lifetime limit. Now, that is going to change for all the high school seniors and everyone younger after that point. So if you are a college student, then I encourage you to make sure that you're eligible for this legacy provision because it'll serve as an insurance policy more than anything else. You may qualify for better rates or lower rates through the private loan market. Of course, that's going to be dependent on your own family's individual credit score, income, debt to income ratio, those types of factors that are considered. But if you have the opportunity to still be eligible for the Parent Plus, it will serve as an insurance policy because that will then serve as the baseline, the worst rate that you will get for the next 1, 2, or 3 years, however long the student is in college. And it'll be up to the time of their time of completion with a maximum of 3 years. And so just want to encourage any seniors here or parents of seniors, excuse me, any current college students rather, and anyone older, if you haven't yet taken out a direct loan, consider that it's still open to you. It's still available as an option for families. Your tuition bill may have been due already, but email me if you have any specific questions about that process. Now, what is the change here for any high school seniors and parents of high school seniors and any student younger than that? The new policy institutes a $20,000 annual limit and a $65,000 lifetime cap. This is per student. And so it's not the case that both parents can borrow. Now, I wanted to mention that because, again, it's a really important change that all families need to know, especially those who are about to go into college in this upcoming cycle. These changes will be in effect starting July 1st. I'll mention a little bit about Juno as well, but a lot of the work that we do is negotiating better rates in the private loan market. And so we come together as a collective group, thousands of families together, and we're actually able to get better rates as a group. An easy way to think about Juno is like a union for student loans. And so we pull together many families who are in a similar position. I'll share more at the end about this. But coming back into today, we'll talk about the Student Aid Index. Again, I mentioned our Appealing Financial Aid webinar is coming up later this week, as well as other opportunities for researching how to pay for college and also federal student loan changes. The Student Aid Index is based on a few different factors. It includes income data, asset information, both from the student and the parents, and then also family size. That has a pretty significant factor on the SAI calculations. All of that is compiled within the FAFSA application. Again, many seniors or parents of high school seniors may have already filled this out, so you're familiar with this process. But after you submit the financial aid application, then the student aid index gets calculated. So this is an index number. I want to be clear about what the student aid index is and what it is not. It's a number that ranges from negative 1,500 to a very, very large number. So the lower your student aid index number, the higher a family's financial need. And so this number is what's used to calculate the financial aid package. It's what's used for schools to allocate federal aid, both state aid as well, and their own institutional funding sources. Now, the number itself is not going to tell you how much total aid you will receive. There's a lot of factors based on the cost of attendance. Cost of attendance can vary at each institution. So the number itself, let's say your student aid index is 10,000. That's not going to necessarily determine that number 10,000 isn't what you're going to pay. It will vary based on the institution, again, based on cost of attendance. It doesn't represent what your family is expected to provide, and it is not the financial aid offer. So I want to be really clear about this again, because there's legacy or there's the previous terminology, the estimated family contribution, which is a bit different, and a lot of families still have that in mind when they're going through the application process. It's the starting point that financial officers use to determine how much aid is provided. And so that is what you'll see reflected in your financial aid offer. Now, your student aid index is going to impact financial aid. And it is relative to what the cost of attendance is. And so again, this can vary by institution, but it's a very simple formula. So you take the total cost of attendance at that specific university, you subtract your student aid index, whatever the number is that you receive, and this should not change college. It doesn't change college to college, so it's the same number across every school. And then that determines the difference between those two numbers determines a family's financial need. So if your student aid index number is lower than the cost of attendance, then you can expect to receive some form of financial need. Now, the composition of that can vary, right? It can be grant funding. It can be in the form of federal, state, or institutional grant funding. It can include loan options. It can include work study. But there will be some level of determined need that the family has shown through this calculation. If your student aid index is higher than the cost of attendance, then it's not likely that you will qualify for financial need. Now, it's not guaranteed because, again, there can be other factors going in, and we get in depth a lot about this when we talk about appealing financial aid. There can be several other extenuating circumstances, high medical bills, circumstances that are not reflected on the FAFSA that then allow you to appeal your award, your financial aid offer, and allow the financial office to reconsider and recalculate based on those the new information and the documentation that you provide. Now, you can see your student aid index once you complete the FAFSA application. So you'll go into your account at studentaid.gov, you'll log in, and then go to the FAFSA submission summary page. And from there, you'll see the eligibility overview, and that will show your student aid index. You'll get your confirmed student aid index a few days after you submit the FAFSA. And so just make sure you go through the process if you have not yet applied for financial aid, or again, I'll speak to some of the younger audiences here for juniors and younger. Please apply for financial aid as early as possible. Create your account as early as you can because federal aid and state aid does run out. Both of them do run out. And so you'll want to make sure you also give yourself 1 to 3 days to get your official student aid index number before you then proceed with the rest of your applications. Now, again, this is just a sample form that you'll see. You'll see the student aid index at the bottom. This number here in this example is 5462. Just to reiterate, the student aid index is not the financial aid award. You will receive the financial aid offer usually at the time of admission that you receive that letter, or in some cases, it can be a couple days or a couple weeks after your admissions decision is released. A lot of schools now are releasing at the same time, but it could take a couple days or maybe a few weeks after. If you haven't heard back several weeks later, then make sure you contact your financial aid office to understand if there's any missing information, any incomplete documentation that's still needed for them to process. All right, so now we're going to get into the bulk of what we'll discuss, which is how the student aid index is calculated. A few important things to know is that it does include both parent information and student information. And the level of uh, the proportion at which the income and assets is assessed ranges for both the parent and the student. It's much higher on the student side, and so I'll show you exactly how that is. Um, but it includes both parent information and student information to calculate the SAI. Income information for this upcoming year is used based on what's called prior year tax information. So in the case of the 2026-2027 FAFSA, it's going to be based on 2024 tax data. For 2027-2028 FAFSA year, it'll be based on 2025 tax return. So take the starting year and then just go back 2 years. That's going to be the income information that's required. Now, very different from that, though, is the asset information. Asset information is based on the value of that asset on the day you submit the FAFSA. And so it is a current value rather than income is 2 years before. And there are income and assets that are protected. We'll talk a little bit more about this here. We're going to go through a tangible example with a family of 4. And in this situation, we have a dependent student with married parents who are filing taxes jointly. The parents' combined income is $80,000. And then assets, the value of the parents' assets is going to be $50,000. Now, one important note here is to not include the value of your primary residence or any retirement accounts on the FAFSA application. These two accounts, again, retirement or primary residence, should not be included at all on your FAFSA. They are not factored in. If you do report your primary residence as an asset, you're overinflating your assets and your SAI number will actually be higher. And so this can be a reason you can correct this, but if you haven't corrected it in time and your financial office has already reviewed your application, you'll need to reach out to the financial office and let them know that you input information incorrectly. For the sake of this example as well, we'll have the student has an income of $15,000 and $2,000 worth of assets. So we're going to start first by calculating the value of parent available income. Now we're going to talk a lot about, again, the terminology and a lot of jargon here. You don't have to remember the names on the left-hand side. Again, you'll have access to this presentation. We'll share the slides, the recording. You can go through this line item by line item just to remember and review. But we'll first start, again, by calculating parent available income. And what that means is that is the parent's income minus any allowances based on the size of the household. So you remember earlier we talked about how family size matters here. For a family of 4, the income protection allowance is $44,880. As the family size increases, more of the income is protected because cost of daily life, cost of living expenses is higher the more dependents that are in the household, the higher the family size. And so that's a huge factor in calculating the parent available income. So you start with that $80,000 income first, and then we also subtract taxes, and then a portion of that, again, $44,000 as well, about almost $45,000 is protected, both taxes and this almost $45,000 number. So what we're left with then is $14,840. This is step 1. So our parent available income, right? We do not start with the $80,000 and then just go from there. Thankfully, there are, in the calculations, there are expectations that families have many other expenses, other bills to pay, so they cannot expect all of a family's income to go towards college expenses. Now, we have the income portion of it. Let's look at the asset side. In this example, we had $50,000 worth of assets. This can include any cash that you hold, any 529 plans, any investment accounts that are not retirement accounts. So, stocks, bonds, if you have cryptocurrency, any investment properties, all of those are reportable assets on the FAFSA. Just to reiterate again, you do not want to include the value of your primary residence. You do not want to include any retirement account information there. Because again, those are not factored in. Colleges will not expect you to sell your primary home, for example, to help pay for college. Families will not expect parents to dip into retirement savings in order to help pay for college. The CSS profile does ask for this information, but it's not factored into the final number that families are the calculation of institutional aid. It's more so meant for financial officers to determine the overall financial health of a family. Now, once you have those assets, you've added those up. I will actually, one thing I'll mention here, because this was a change from last year to this year, any family-owned businesses with 100 or fewer employees are also not included as an asset. Once you have that total net worth of your assets, then you multiply that by 12%. And so parent assets are only assessed at 12%, which will give us now the $6,000 parent contribution from assets. Then we'll add those two together and we get the adjusted available income. So we're now getting a little bit higher at $20,840. But we have one more adjustment to make. So we have two adjustments that we make to determine the parent contribution side. The second adjustment that we make is going to further reduce the overall number. And so you can think about this almost like a tax bracket. So whatever this remaining amount is, so currently we are at $20,840. Whatever the available, the parent adjusted available income is, it is assessed on a marginal rate. So anything less than $21,800, which is true in our case, is going to be assessed at a 22% rate. Then any dollar above that, so from the first 21,800 is assessed at the 22% rate. Then anything above that, so marginally from 21,801 to 27,300, only that portion, only that amount above the initial 21,800 is assessed at the 25% rate, and so on and so forth. So the maximum marginal rate will be 47%, and that's only on any value of above $43,901. So we multiply by the marginal rate, and then again, in this case, our situation is 22%. And so that brings us to a final parent contribution of $4,585. So we have two adjustments to make. I know, again, it's a little bit of a complicated formula, but we have two adjustments to make. And now we go from the total available income, $14,840, to the final parent contribution of $4,585. Again, this is a good thing because it is a lower amount. We're not only looking at that 80,000 income, we're not only then looking at the parent available income, but there are several adjustments that we have to make in order for it to be realistic, a realistic number of how much a family can afford to pay based on where their income ultimately is. So we're going to hold on to this number, the $4,585. And we're going to now focus on the student side of things. So we had the $15,000 student income. We have to get to the student available income next. This information is automatically transferred from 2024 tax returns. On the FAFSA, you have to agree to this, and so you don't have a choice. You have to agree to the IRS data retrieval tool, and it pulls in your information automatically. Now, it's a great thing to have happen. It reduces your FAFSA completion times to a much shorter amount. So don't worry about that in terms of being required to include the transfer in your application, because that will make the process a lot simpler. Now, similar to how we did the parent income, we have a few allowances for the student income. So we'll subtract taxes paid on the $15,000. And then for dependent students, $11,770 is excluded. Because again, student may have their own expenses, they may have their own bills, cell phone, maybe a car payment, food, other expenses that they may have. So the student income also has protection where up to a certain amount, up to $11,770, that is excluded from the student income calculation. Now that leaves us with the $583 left. From there, student income is assessed, student available income, excuse me, is assessed at 50%. So only half of what the available income is, you reduce that, you multiply that by 50%, and that brings us down to $291. Now, keep note here that the student income assessment rate is much higher than the parent assessment rate. If you remember, both on the income and the asset side. So here, about 50% of a student's income is going to be considered for the calculations here. Any income above $15,000 is where you really start to add meaningfully to the student aid index number. Again, right now in this example, we can see it's fairly small, but anything really above that is when it's going to start to make a bigger difference. Student assets are also factored in. We're going to then think about the net worth of all the students' assets. So not the total value, but only the net worth. So any cash the student has, investments, some students do have businesses that they have, that they've started. But again, if it's over 100 employees, then you report it. If it's not, then you don't have to report it. This was a change from last year to this year. And then if a student has if the 529 plan is owned by the student, not owned by the parent, but owned by the student. These assets get assessed at a 20% rate. Now, similarly, this is much higher than any parent assets. So this is going to be important for families to consider if, in the interest of reducing your student aid income, any student income and student assets are assessed at a much higher rate. So 50% on the income side for students, for student income, and 20% on student asset side. This is much lower than parent assets, which are assessed at a maximum of 5.64%. And so it's important for families to then consider that, and any assets that can be in the parent's name are better off being in the parent's name instead of the student's name. So here we'll take 20% of 2,000, and that leaves us with $400 for the student contribution from assets. We're going to put it all together, and that's what's going to give us the student aid index number of 5276. So again, you can see this once your FAFSA is processed. Income is going to be automatically pulled. The asset information is based on the value that the value of those assets on the day you submit the FAFSA, so it's current values. And ultimately, the lower your student aid index number, the higher your need for financial aid. So if this student attends a university that has a cost of attendance higher than $5,276, if you remember the formula, cost of attendance minus student aid index determines your final financial need, then this student would be granted some form of a financial aid package. Now, this is a very busy screen here, so I don't want you to get lost in the numbers, but I will just show you this example for the family of four situation that we were describing, but we're going to assume no income and no assets just for simplicity's sake here. So in this chart, you can look at, let's say, if a parent assets are around $250,000, and let's just pick one right in the middle. So parent assets are $250,000 and parent income is $150,000. If you find that on the chart, you'll see that we get to this number right in the middle at $36,631. So that will be the student aid income. And if a school is less than $40,000, then this family would reasonably expect to receive some form of financial aid package. Now, again, in this case, it's going to be a relatively small package in the amount of about $3,300 or so, $3,300. And that could be made up in terms of work study options. It could be additional loan options that the student may have to take out in their name. But anything in the yellow, in this scenario, there is a financial need for a cost of up to $40,000. Anything in the green, you'll see, so $40,000 is usually around the cost of attendance for any public universities. $90,000 now is sort of around the cost of private universities. And so this family would have some sort of financial need. In the green, you'll see for any cost of attendance of up to $90,000. And then beyond that, there's generally not going to be any financial need that is offered. So this is a rough and quick way for a family to say, okay, if this is relative to your situation, again, it'll be different based on your family size, based on income and student income and assets, as well as on the parent side. But this is a quick way to see reasonably, could you expect some level of financial aid or not? Now, importantly, how can you minimize the student aid index number? That has the direct effect on what your financial need is. So first, you can think about asset purchase timing. If you know you have a pretty big purchase upcoming, then you can think about the strategic timing of that purpose. So let's say, for example, you have a leaking roof and maybe your insurance doesn't cover all of it and it's only in part. And suddenly you're hit with a $5,000 to $10,000 bill. Now, in that scenario, if you use your savings to help pay for this out of pocket or any other out of pocket, maybe it's a medical bill, maybe it's a new car because your only form of transportation for work has broken down, or a significant car repair, right? In those scenarios, if you know you need to make a pretty substantial purchase, then using any of your savings or available, even potentially even available assets, other available assets to you, that would reduce the total reported assets. Now, I don't want to overinflate this because, again, you saw that the maximum assessment rate was only 5.64% on parent assets. So it may not make a huge impact on the student aid index number, but it would have some impact, right? Particularly if you have a very large expense upcoming. Now, what I want to be really clear here is that we are not encouraging irresponsible spending, right? Because again, the impact is going to be relatively small in the grand scheme of the total calculation numbers, because parent assets are assessed at a much smaller rate. But think about this in terms of if you know you have an upcoming significant cost, then again, any available assets that you use before you report your assets when you fill out the FAFSA will no longer be there because you've used them on that purchase that you have to make. Now, one other caveat I'll mention here is that I would encourage this to be some form of a true need rather than some kind of want. So a sudden home renovation, if it's not, required, you're not going to put yourself in the best position financially to help pay for college because again, the impact is going to be on the lower end. So be really mindful about how you're choosing to make these purchases and make sure that it is a required, necessary purchase. Don't report the value of small businesses. Now, again, I referenced this earlier, but any family-owned businesses with less than 100 full-time employees, you're no longer required to report. You also don't have to report for anyone who's tuning in who lives on a farm. If your primary residence is on the farm that you manage, then you do not have to report that on the FAFSA. Similarly, there's a new change as well. Any family-owned commercial fisheries are no longer required to be reported on the FAFSA. So don't report the net worth of those assets. Now, I just mentioned that you want to report the net worth of these assets. So if you do own a second home, maybe an investment property, and let's say it's $300,000 property, and you have a $200,000 mortgage on it. You want to subtract any debt that you owe, and what you're left with then is the net value. So you would only report $100,000, not the $300,000. Again, that's going to play a larger role as well in determining your total asset amount. and then how your SAI gets calculated based on that. Because if you do just report the overall value, if you look at Zillow and you report $300,000, then you're overinflating the assets that you're actually required to report. Additionally, 529 plans that are owned by a grandparent are not actually considered an asset on the FAFSA, and it's not included in the student aid index. So only parent assets and student assets are reported on the FAFSA. Anyone outside of that who may own a 529 plan on behalf of the student as a beneficiary is not expected for it to be reported on the FAFSA. We described as well how family size is a really important part in the calculation of the student aid index. If your family size has grown, make sure you update that because that will increase the income protection allowance on your financial application. And then appeal your financial aid if your income has decreased. Again, income is used from 2 years ago, prior year. And so if there's been any changes, then please make sure you contact your financial office to report your new income, and that will likely reduce your student aid index number if your income has gone down. Okay, so let's talk about, again, a specific example of a financial aid package using the same example that we've been talking about up to this point. As a reminder, we had the student aid index number of 5,276. Now we'll use that on the actual calculation here. So we'll take the total cost of attendance, and let's say this institution costs $20,000. We'll subtract the student aid index amount, and we're left with the total financial need, $14,724. Now, there are forms of federal funding that are available, both grants and loans, that will reduce the remaining need. So in this case, a student can qualify for the federal Pell Grant. The amount is about $2,100. They may get an additional $1,000 FSEOG grant, which is an additional grant, is the Federal Supplemental Education Opportunity Grant. And then maybe the school packages a $1,000 work study. This can range anywhere between $1,000 to $4,000 or $5,000 usually. It's an amount that the student is working to help for the cost of college. Those are the grant funding sources and work. So work is not technically free. A student has to have a campus job for that, but that gets calculated in the financial aid package. Now, students also have opportunities to take out loans directly in their name. So first is the subsidized direct loan. For freshman year, the maximum amount for that is $3,500. And the subsidized loan is great because the federal government pays the interest on the loan while the student is in college. So this is the best form of loans that you can take out, and it will be the primary and the first source of loans that you should take out. Now, please be aware that not all families qualify for the subsidized direct loan, so you do have to have financial need in order to qualify for that. And in addition to the subsidized loan, there's an unsubsidized direct loan that the student can take out. So the family is not, the federal government is not paying the interest as it accrues on this loan, but it is an additional funding source that's available to the student. Now, after we subtract all of that, we get to this final remaining need number of $5,105. From there, again, we talked about the federal Pell Grant. This is a free funding that's available to the students who have the most need. Generally, you can see the chart here on the right-hand side, whether a student will get a max Pell amount or anything in between. There's a maximum and a minimum allowable amount. It is based on a parent's adjusted gross income. And so this may or may not be part of a student's financial aid package. From there, right, we can see how we got to this $2,100 number, 2,119. You take the max Pell amount, you subtract the student aid index, and then that's where you get the remaining amount. If your student aid index is above $6,650, then you won't qualify for the max. And so you likely won't get the Pell Grant at that point in time. But anything below that, then you can expect to receive some form of federal aid through the Pell Grant program. Again, we talked about FSEOG as well. This source of funding is very quick to run out. And so for any students younger, juniors or younger here, please make sure this is why we advocate applying for aid early. Schools are given these funds through the federal government to help the students who have the most financial need. And so a school may offer a $500 additional grant for the student, but they may offer an additional $4,000 grant to the student. It really does determine on how many students are needing additional funds that year, and also what your family situation is and how much aid you might need to receive. So please apply early. This is free money that doesn't have to be paid back. Federal work study can also be included. Federal work study is a little bit distinct from just any other campus job because the federal government actually subsidizes the job in part. So it's paid in part by the federal government funds and also in part by the university. And this is specific for students who have financial need. And so there's specific job opportunities on campus that are designated federal work study. You don't have to do this. It's not a requirement. And so students don't need to work on campus, but it is an opportunity for a student to earn a little bit more income. And it could be higher than $1,000 as well. It could vary by school, but just as an option to help defray the cost. And then we talked about direct loans as well. The direct and the subsidized and the unsubsidized loan. And so once we think about all of those factors, we get to that final remaining need number. That would be, in this example, $5,100. Schools may also have additional institutional aid to help fill the gap. This is critical, and this is where having an open dialogue with the financial office can be really important. You can appeal your financial aid award. Financial aid officers do have the opportunity to adjust a student aid index number based on documented evidence that you have provided on certain aspects of your financial situation. If there's been a job loss, if there's been a huge change in income, if you've had high medical bills, there are a range of options where a financial officer can leverage their professional judgment, again, with evidence because they're required to document it. And that's where you can maximize those institutional funds that are available. We always encourage families to apply for external scholarships, $500 here, $1,000 there. It can really go a long way. Anything after free money, that's when you might begin exploring the federal loan options, the Parent Plus options, or private student loans. Now, again, I'll just mention really quickly here a little bit about Juno. Again, we started as an initiative by students at Harvard Business School who ultimately saw that first college is expensive and it's expensive to borrow money. So from there, they actually gathered a group of 700 students from across business schools around the US and negotiated a better deal with a lender who was willing to offer a better rate based on the collective volume. And so what we're doing now at this point in the year is asking families to join our waitlist. It's very simple. We never ask families for any money. There's no place on our website to input credit card information. Juno is free for all families. Again, we will never charge families for this. What we're doing now at this point is building the negotiation group as large as we can so that we have more leverage when we go to different banks and lenders and say, hey, we have now, let's say 20,000 families in our group negotiation. What rates are you able to offer to the Juno members? And so when we have more families involved, then that catches more interest from the lenders, and they're willing to trade margin for volume. They want to win the collective business of the entire Juno group. And so we run an auction in May, in this late springtime. And from there, we compare the offers and make the best offers available to Juno families. If you want to join, it really does help the collective. I'm in this group myself. I don't just work at Juno. I'm actually currently a grad student, and I use Juno for my loans. That's how I first heard about the organization, is through being a happy user. And so it really is all of us coming together all families who may need to borrow for undergrad loans, for graduate school loans. And that's what brings our collective voices together in order to secure better deals. Again, there's no cost to sign up. There's no credit check. If you join the Juno group, you do not have to take out a loan. What you're doing is effectively signing up for a mailing list to agree to be contacted once we've negotiated a deal. And so there's a little bit of information that we ask on our form. Again, it's very simple, but it's student name, if they know what university they're going to, if the student has a credit score, and a cosigner credit score, and a few other small pieces of information. It's fairly straightforward, very simple. It's not going to take long to do at all. And so this allows us to just bring that a little bit of information to banks in the springtime and say, this is the general creditworthiness of the group that we have, right? Banks need to know a couple pieces of information, but ultimately that's what we do in collecting information, but it's not sold anywhere, right? You're not obligated to take out a loan. It's just being part of the membership so that we can negotiate the best deals. It's a free option. You can explore, and we actually actively encourage you to explore all of your loan options when it comes to that time. So don't just take my word for it. Explore what everyone is offering. See all the different. You can do different rate checks for free. There's soft credit inquiries. See what many different lenders are offering. Now, last point that I'll make here as well, if you have any questions, feel free to reach out to us. I've spoken with so many families all throughout last summer for free one-on-one support throughout this. We can jump on a Zoom. If you have email questions, send those my way. We can have a phone call as well. We make ourselves available, and this is something that we're really proud of because Juno, we're not a lender, and so we're agnostic about which lender we ultimately choose. It's the one who's going to offer the best rates to the Juno membership. And so we want to make sure that families are getting the best rates possible. If you have any questions, please feel free to reach out. I'd be happy to meet with you directly. You can respond to the email. I'll follow up tomorrow with, again, the slides, the presentation. Feel free to reach out, sign up for a free conversation. Be happy to help support you through this process. Last thing I wanted to mention, and then please feel free to post any questions in the Q&A. We just launched a free tool that's available for all families. This is to help maximize the financial aid that you receive from universities so that you do not have to borrow as much. It's our financial aid appeal generator tool. And so this works for all students who are in college. And so whether you're a high school senior or you're currently in college, please make sure to check this out. The link you'll be able to click once you get the slides is just joinjuno.com/appeal. Play around with it. Even if you're not going to college next year, just play around with it anyways to see, to familiarize yourself with this process, because the best starting point that you have is for especially freshman year of college is receiving the most competitive financial aid offer possible. And then from there, you do still have to apply for financial aid every single year. And so it is adjusted based on changes, but having that foundational strong starting point at the beginning sets the tone. Now, you can submit an appeal based on merit. You can submit an appeal based on need, financial need. There's also options for a dependency override. I won't get too much into that, but also if there's been changes, an appeal based on multiple children in college. So if you're a parent here and you are paying for 2 students in college versus 1, that's really important information for financial officers to know. You can include different schools that you've applied to, that you've received offers from, and the total cost, the net cost to your family. The tool will then use the best peer institution to maximize your financial aid appeal letter. You'll get a summary of several key points, and then also what I think is really helpful is including certain documentation to help verify what you're stating in your appeal. Now, this tool is great not just for families, but also for financial officers, because we're really trying to minimize the back and forth, having to appeal, okay, I go back and forth with financial officers and say, okay, you forgot to include your final pay stub. You forgot to include a termination letter. You forgot to include the medical bill, you forgot one particular medical bill, right? So just make sure that this is meant to be as comprehensive as possible to collect all of the source of information that you might need so that the first time around, you're giving the financial officer all of the comprehensive information for them to make that professional judgment assessment and potentially change your SAI number to be able to afford more aid. Okay, let's go to Q&A. And again, please feel free to post anything else that might come up here. If your retired in-laws live with you and you support them financially, but don't claim them on tax returns, can you add them as part of family size? Great question here. So this does depend. And so there are cases in which, I'll speak from the student's perspective here, in which grandparents or elderly family members are living in the home with the family. So if the family is providing over 50% of the basically the financial expenses for the grandparents, again, from the student perspective, then it is possible to claim them in your household size. Now, this can vary, and where it gets tricky is it can depend on any kind of retirement accounts that the grandparent might have in their name. So if they're collecting Social Security, if they're collecting dividends, if they have, a particularly large asset profile, there are scenarios in which it won't count. And so again, it's a little bit more nuanced than just a yes or no answer. It is possible, yes. There are cases in which sort of a voluntary, family members, elderly members voluntarily living with the family may not necessarily count. The strongest case is if there is some sort of medical need, medical attention. If a family is paying significant medical bills on behalf of the grandparent, then that's a huge expense. If a family is paying for any kind of elder care facilities, right, and the grandparents themselves don't have the resources to meet those obligations, or maybe they've exhausted any kind of retirement benefits that they may have. So yes, it's possible. Again, but I wanted to share it's not always the case where you can just have family members come live in the household, claim them, or try to claim them, and then reduce, so let's say in the example, you go from a household of 4 to a household of 6, which has a much higher income protection allowance. It's not always the case. I just want to be really clear about that, but excellent question. So 2 questions here that I see as well. How does the scenario change with divorced parents? Great question. So one remarried with additional children, for example. So this was covered. I'll reference some of our past presentations. We cover a lot. It's a common question we get on our FAFSA presentation. And so in the case of divorced parents, for the purposes of the FAFSA, then the parent who provides 50%, more than 50% of the student's financial needs or financial cares for the student's financial expenses is considered the contributing parent on record. So contributing parent is basically the student who is more financially responsible for the student's expenses over the last 12 months. Now, this is not always the parent that the student lives with. So I want to be really clear about that. It can be, a lot of times it is, but it's not always the case. So there can be cases in which the parent that the child does not live with in a divorce situation is providing child support, and that child support constitutes over 50% of the care that the child is receiving. So in that case, that parent is the parent of record for FAFSA, and their financial aid information is included on the FAFSA, not the other parent. Now, if the parent for whom which the child is living with is also providing more than 50%, then only that parent's financial aid information is included. So in the case of divorce, then the divorced parent who provides more than 50% is included. Now, it goes one step further beyond that. So let's say in this case, I'll just say parent one and parent two for the sake of simplicity. Let's say the student lives with parent one, but it's determined that parent two provides more than 50% over the last 12 months of the child's expenses. Parent two is the contributing parent of record for the FAFSA. Now, that's clear. Let's say in this scenario, if parent two is the contributing parent, it doesn't matter if parent one is remarried because parent one is not even factored in. However, if parent two is considered the contributing parent for FAFSA, then that information is used. Then we go one step further. If parent two is remarried, then that's where both parent two and the remarried spouse, excuse me, the new spouse, their joint information is then included on the FAFSA. There's a really helpful tool. It's through the Department of Education. It's linked in one of our previous webinar slides on who is considered a contributing parent on the FAFSA. If you send me an email, Craig, I can send you the link directly. Great question. Sorry, it was a little bit, I hope that wasn't too in the weeds, but there's a whole decision tree that the Department of Education has laid out in terms of who counts, who doesn't, and it's very helpful. They visualize it in a really great way. And then another question here. Does the example leave about 15,000 in student family costs? Does 5,200 from SA, 5,500 from unmet need, possible parent plus? I think, let me go back. I think this, you may have been referring to, this slide, I believe. So here, yeah, what we see is the total financial need. That's just the difference. You take cost of attendance, you subtract student aid index. That's the financial need. That's the amount that a school can give in financial need to help meet this need. So it's the maximum amount. So a student can receive up to a maximum of $14,724 from a college. They can't exceed this. You can't receive more financial need than what is calculated as your need. You may not always, not all universities will meet full need. This is a great question to ask in admissions presentations. So does the school meet full need? Because if yes, they do, then a school will provide a financial aid package that meets this $14,724. Now, what's important to be really mindful is how a school meets that need, right? Because how much loans will they include? Every university will include the $5,500 direct loans, both subsidized and unsubsidized for students. So that amount is usually baked in. Now, the amount can vary, again, from Pell Grant, FSEOG grant. A student may or may not qualify for those. Work study can vary as well. So again, we mentioned it could be $1,000, it could be $4,000. So how much is a student going to be expected to work on campus? So be mindful about how much these different amounts end up being, these specific amounts, and in how a total need is met. So then the remaining amount, this 5,000 that you see now, is figuring out how to pay for that. So that can be, usually on the parent side, it could be a Parent Plus loan. It could be private loans. As we mentioned, Parent Plus loans are now getting capped at $20,000. So if this remaining need, the cost of attendance at this school was fairly low at $20,000. But if we think about it, let's say a private institution where let's say the cost of attendance is $70,000, and a family might receive maybe a student receives a $20,000 scholarship, but you still have 50,000 in remaining need, right? Then of course you can figure out which levers you might need to pull, how much is determined from your income and assets, and how much you might need to take out in private loans. Excellent questions. I don't see any other questions. I'll wait just another few moments here. If you have a question that you'd rather not ask in a public webinar, feel free to email me directly as well. I'd be happy to answer it through email. We can jump on the phone as well if you prefer that. I'll just give it another moment here to see if there's any other final questions that come in. All right. I'm not seeing anything else come in, so we will call it there. Thank you so much for joining us. I'll follow up again with a copy of the presentation, the webinar. Any additional questions you have, always reach out to us. You can contact me directly. You can reach out to our team, and we'd love to help you through this process. Wish you all a wonderful evening and have a great night.